Welcome to the Deep Dive, where we cut through the complexity of big topics to give you clear, actionable knowledge. Today, we're plunging into the fascinating, often intimidating world of financial markets. You've undoubtedly heard terms like stock market or bond market, but what are these vast, interconnected systems really all about? Our mission is to strip away the jargon, illuminate the key players and structures, and give you a comprehensive understanding of how money truly moves in the global economy. Think of it as your essential shortcut to being well informed about the financial arteries of the world. We've got a stack of sources, and we're ready to extract those crucial nuggets of insight for you. Let's get started. So let's unpack the very essence of it. What exactly are financial markets?
Right. Well, fundamentally, financial markets are the engines of an economy. They are where individuals, companies, and governments connect to buy and sell financial assets. Imagine a giant interconnected marketplace where funds are channeled from those who have extra capital, the savers, to those who need capital, the borrowers. This vital connection serves two main purposes for the economy and for you as an individual. They provide avenues for investors to grow their wealth,
Okay.
and they enable businesses to raise capital for expansion. This whole system, with its diverse participants from institutions to individual savers, operates within a framework of laws and networks to keep things running smoothly.
Right, so not just one monolithic thing. Financial markets aren't just one big entity, they're more like a complex tapestry. Our sources classify them in several fundamental ways based on the nature of what's being traded, how they're organized, the duration of the financial commitment, and when a deal actually gets done. Let's unravel these categories to understand the full picture.
Absolutely. And understanding these distinctions is crucial because each type of market has its own unique characteristics, risks, and opportunities.
Yeah.
It helps you grasp where and how capital flows and what that means for different parts of the financial system.
Okay, first up, what's being claimed? Debt market versus equity market. The debt market is essentially where money is borrowed and lent. It's primarily about bonds, which are like IOUs, right?
Exactly.
This market is pivotal for mobilizing resources, especially in economies needing to grow their infrastructure. For instance, governments issue securities like Treasury bills or longer-term bonds to fund public projects. Companies also tap into this market to raise money, often through what's called the corporate debt market, which provides a long-term capital channel for private businesses. Then we have the equity market, often what people think of as the stock market. This is where companies issue shares to raise capital. When you buy a share, you're not lending money, you're actually buying a tiny piece of ownership in that company.
So what's the core difference between these two for a company and for an investor? With equity, a company isn't taking on debt. It's exchanging ownership. There's no obligation to repay the principal to shareholders.
Okay.
With debt, the company is indebted. It has to repay the principal plus interest by a specific date.
Right. Clear obligation.
For investors, equity is generally riskier as returns depend on the company's performance, but it offers potentially higher rewards. Debt, on the other hand, typically offers more predictable fixed returns with less risk, as you're a creditor, not an owner.
Makes sense.
Yeah.
Okay, next, let's consider their structure. Exchange-traded markets versus over-the-counter or OTC markets. Think of exchange-traded markets as highly organized marketplaces like a stock exchange. They're centralized with strict rules, standardized contracts, and direct supervision. You know exactly what you're buying or selling and who's regulating it.
Like the NYSE or the NSE in India.
Exactly. OTC markets, by contrast, are more like a vast, decentralized network of individuals and firms, often connected by computers and phones. Trades are privately negotiated directly between two parties, perhaps a bank and its corporate client. These deals are often customized and typically much larger than what you'd see on an exchange.
Right. The key distinction here is about control and customization. On an exchange, the exchange itself acts as a central counterparty,
Okay.
guaranteeing the trade and significantly reducing the risk that the other side of your trade might default. This makes exchanges very transparent and safe.
Less counterparty risk.
Precisely. OTC markets, however, are bilateral. You're dealing directly with the other party, which means you take on what's called credit risk from them. The upside of OTC is incredible flexibility. You can tailor contracts precisely to your needs, which is why markets like the global foreign exchange market,
Forex.
where currencies are traded 2047, are primarily OTC.
Got it. Okay, another way to classify markets is by the maturity period of the instruments traded. Money market versus capital market. This is essentially about short-term versus long-term funding.
Duration, basically.
Yeah. The money market deals in financial instruments that mature in 1 year or less. It's the go-to place for short-term borrowing and lending, helping banks and companies manage their immediate cash needs. Think of Treasury bills, which are very short-term government debt, or call money, which is essentially overnight lending between banks.
Right, very short horizons.
The capital market, on the other hand, deals in long-term claims, meaning instruments that mature in more than 1 year. This is where companies raise funds for long-term growth, like building a new factory or expanding operations. This includes stock markets, where equity is traded, and bond markets for longer-term debt.
And the essential takeaway here is their distinct purposes for the broader economy. The money market provides short-term liquidity, allowing participants to manage immediate cash flow, crucial for operational needs.
Keeps the wheels turning day to day.
Exactly.
Yeah.
The capital market, however, is all about fostering long-term growth and capital formation for the economy,
Right.
enabling major investments that drive innovation and development. Think big projects, infrastructure.
Okay, final classification. Timing of delivery. Spot or cash market versus derivatives market.
When does the actual exchange happen?
Yeah, the spot market is straightforward. It involves immediate transactions on a cash basis. You agree on a price today, and the actual exchange of cash and asset happens very quickly, usually within a day or two. For instance, in many stock markets around the world, when you buy a share, the settlement is often T+1, meaning the actual transfer of ownership and funds happens 1 business day after the trade date.
T+1. Trade date
Right.
plus 1 day.
Right. And this system has become progressively faster over time, aiming for near instant settlement in the future.
Efficiency gains.
The derivatives market is different. It deals in instruments like futures and options, whose value is derived from an underlying asset, like a stock or a commodity. These instruments are primarily used to manage price risk, but they also offer opportunities for speculation.
Definitely. And the derivatives market has a diverse set of participants, each with a different motivation. You have hedgers who use derivatives to reduce their exposure to price fluctuations. Think of an airline buying fuel futures to lock in a price.
Makes sense, manage their costs.
Then you have speculators who take on risk, betting on future price movements to profit.
Trying to predict the market.
Exactly. Arbitrageurs try to profit from tiny price discrepancies of the same asset in different markets by simultaneously buying and selling. Almost risk-free if done right.
Finding those little gaps.
And margin traders use borrowed funds to amplify their potential returns, though this also significantly increases their risk.
Leverage. High risk, high reward potential.
You got it. What's crucial for derivatives, especially on exchanges, is the transparency they offer on current prices and volumes. Helps everyone understand the market.
Okay, so now let's look at how financial securities actually come into existence and then get traded. This involves two crucial segments: the primary market and the secondary market.
Where things start and where they continue.
Exactly. The primary market, also called the new issue market, is where brand new financial securities are issued for the very first time. This is where a company goes to raise capital directly from investors. A well-known example is a company's initial public offering, or IPO, which is its first public offering of shares, leading to them being listed on a stock exchange.
The big debut.
Yeah.
And the primary market offers companies several ways to raise fresh capital. An IPO, as you mentioned, is the company's grand debut to public investors. This can be a fresh issue, where the company issues new shares, increasing its capital.
Bringing new money in.
Or an offer for sale, where existing shareholders simply sell their shares and the company's capital doesn't change. The money goes to the sellers, not the company.
Ah, okay, important distinction.
Definitely. After an IPO, a company might issue more shares through a follow-on public offer, or FPO, to fund further growth. Companies can also offer shares exclusively to their existing shareholders through a rights issue, often at a discount.
Rewarding loyalty, perhaps?
Sort of, yeah, giving them the first chance to buy more. Or distribute additional shares for free through a bonus issue, typically from accumulated profits. And for speed and efficiency, companies might also opt for a private placement, selling securities to a select group of typically large, sophisticated investors, rather than a wide public offering. Avoid some of the public hassle.
Like institutions.
Right. Qualified institutional buyers, or QIBs. Often, it's faster and sometimes cheaper.
Okay, so once securities are issued in the primary market and listed on an exchange, they move to the secondary market. This is where those already issued securities are bought and sold among investors rather than directly from the issuing company. This is what people generally refer to when they talk about the stock market or the OTC market for existing bonds.
Exactly. The key characteristic of the secondary market is that the issuing company isn't directly involved in these trades. Instead, transactions happen between investors.
Peer-to-peer, essentially.
In a way, yes. Stock exchanges and other intermediaries provide the essential infrastructure for this trading, clearing, and settlement. This market provides vital liquidity, meaning you can easily buy or sell your shares or bonds when you need to, which is a huge benefit for investors.
Makes it easy to get in and out.
Precisely. Without a robust secondary market, people would be very hesitant to buy new issues in the primary market. Why buy something you can't easily sell later?
Good point. So when we compare primary and secondary markets, what's the ultimate takeaway for our listener?
The fundamental distinction is simple. In the primary market, the company itself is directly involved as the issuer of new securities, raising capital.
Company gets the money.
Right. In the secondary market, the company has no direct involvement. All transactions occur between existing investors. The company doesn't get money from these trades.
Okay.
But despite this difference, they're interdependent. Securities issued in the primary market are typically listed on an exchange, which facilitates their trading in the secondary market.
Which provides the liquidity.
Exactly. Thereby providing liquidity and making them attractive to investors in the first place. One feeds the other.
Got it. Let's focus specifically on the capital market now, which is where long-term funds are raised and traded. What are the key instruments and players here?
Right, so capital market instruments, by definition, have maturities of more than 1 year. The two primary instruments you'll encounter are stocks, also known as shares, and bonds. Their availability is absolutely vital for long-term capital formation and the overall economic growth of a country.
Okay, let's start with shares, or equity. He said, this represents ownership.
That's right. When you subscribe to a new issue or buy from an existing owner, you become a part owner of that company.
And as a shareholder, you're taking on entrepreneurial risk, but you're also entitled to a share of the company's profits, typically through dividends, and potential increases in the company's value, capital appreciation.
Exactly. Your returns really depend on the company's success and the growth in its stock price.
So some key terms here people hear a lot.
Yeah, definitely. Face value is the nominal value printed on a share, usually quite small, often historical. But the more important number is the market value, which is the current price determined by supply and demand in the market. That's what it's actually worth today.
What people are willing to pay.
Right. Dividends are distributions of profit to shareholders. Not guaranteed, depends on the company's policy and profits. And then you have important metrics like earnings per share, EPS, which is the company's net profit divided by the number of shares outstanding. Shows profitability per share. And the price to earnings, PE ratio, which is the market price divided by the EPS. It tells you how much investors are willing to pay for each dollar of a company's earnings. A high PE might suggest high growth expectations or that it's overvalued.
A key valuation metric.
Very much so. And market capitalization, or market cap, is simply the total value of all outstanding shares. Number of shares times the market price shows the overall size of the company in the market's eyes.
Okay. And are there different types of shares?
Yes. Beyond common shares, there are preference shares. These are also part of a company's capital, but they're a bit of a hybrid. They typically have a fixed dividend payment and a preferential right to be paid back if the company goes out of business, putting them ahead of common shareholders.
So less risk than common shares.
Generally, yes, in terms of getting paid back. However, they usually have limited or no voting rights. So you trade voting power for that preference.
Interesting trade-off. Now, bonds and debentures, both debt instruments.
Correct. Both signify an obligation for the issuer to repay borrowed money.
A debenture is essentially a company's debt instrument, a promise to pay back money with interest by a certain date. Bonds are broadly similar. The distinction can sometimes be a bit fuzzy, you said.
It can be, and usage varies geographically. But generally, in many contexts like India, debenture often refers to corporate debt, potentially unsecured.
Okay.
But the bonds are often used for debt issued by governments, municipalities, or large financial institutions, and are typically secured. But it's not a hard and fast rule everywhere.
Good to know. And within bonds, you mentioned types like zero-coupon bonds.
Yes, ZCBs. They don't pay periodic interest, but are issued at a discount and redeemed at their full face value. The profit comes from the difference.
Like T-bills we mentioned earlier.
Exactly. T-bills are a type of ZCB. And floating rate bonds, whose interest rate isn't fixed, but adjusts periodically based on a benchmark rate, like a prevailing interest rate in the market. This protects investors against rising interest rates.
Adapts to the market.
Precisely.
Okay, moving on to derivatives. You said their value derives from something else.
Exactly. They derive their value from an underlying asset, which could be anything from a stock, a bond, a commodity like oil or gold, or even an interest rate or an index. They're primarily used to manage risk, hedging, but also widely used for speculation.
And the main types.
The broad categories include futures, which are standardized contracts traded on exchanges, obligating you to buy or sell an asset at a pre-agreed price on a future date.
Standardized is key there.
Very key. Then there are options, which give the buyer the right, but not the obligation, to buy or sell an asset at a specific strike price before a certain date. A call option is the right to buy. A put option is the right to sell.
So more flexibility than futures.
Yes, you pay a premium for that flexibility, that right. Forwards are similar to futures, but are customized. Private agreements traded OTC, not on an exchange, tailored, but carry counterparty risk.
Back to the OTC versus exchange difference.
Right. And finally, swaps are typically OTC contracts where two parties agree to exchange financial instruments or cash flows over time, often used to swap interest rate types like fixed for floating.
Complex stuff. Okay, last instrument type here. Depository receipts. Allows investing in foreign companies.
Yes, they're quite clever. They allow you to invest in foreign companies' equity, but trade them right on your local exchange, in your local currency.
The most common examples are American Depository Receipts, or ADRs, which allow shares of non-U.S. companies to trade on U.S. exchanges.
That's right. So an Indian company, for example, could bundle its shares, deposit them with a U.S. bank, and that bank issues ADRs representing those shares, which then trade on, say, the NYSE or NASDAQ.
Subject to U.S. rules, of course.
Of course, SEC regulations apply. Similarly, global depository receipts, or GDRs, are traded outside the U.S., often in Europe, like London or Luxembourg.
And can foreign companies issue these in, say, India?
Yes, though less common, the mechanism exists. Standard Chartered Bank launched an Indian Depository Receipt IDR issue back in 2010. It allows a foreign company to raise money in India using this structure.
So basically, these DRs bridge markets, allow companies to tap into global capital pools, and give investors easier access to international companies.
Exactly. Makes global investing much simpler.
Okay, let's shift to the essential gears that make these markets run, the intermediaries. A stock market or stock exchange is the obvious hub where equity shares are bought and sold.
Right, like the BSE and NSE in India or NYSE and NASDAQ in the US. They provide the platform.
And within these markets, certain terms pop up constantly. You mentioned benchmark indices like Nifty and Sensex in India.
Yes, they track the performance of a basket of top companies, giving a snapshot of the overall market direction.
And when people talk about a demat account,
that's simply an electronic account where your shares and other securities are held in dematerialized form. No physical paper certificates.
So dematerialization is just converting paper to electronic.
Precisely.
Yeah.
It was a huge step forward in security and convenience, eliminating risks like theft, forgery, and damage of physical certificates. Makes trading much faster, too.
Okay, who else is crucial in this ecosystem?
Well, you have stockbrokers. They are members of the exchanges, and they're the ones who actually execute trades for investors like you. You can't just call up the NYSE directly. You need a registered broker.
Your access point.
Exactly. Then there's the depository system we just touched on with demat accounts. This system, enabled by laws like the Depositories Act in India, is what securely holds and transfers securities electronically. In many markets, like India, you typically have two central depositories like NSDL and CDSL that oversee this electronic ledger.
And how do we interact with them?
Through depository participants, DPs. These are agents of the depository, often banks, brokers, or other financial institutions who act as your interface. You open your demat account with a DP.
Got it. And finally, clearinghouses. You call them unsung heroes.
I think so. After a trade happens on the exchange, the clearinghouse steps in the middle. It ensures that the buyer actually receives the securities and the seller actually receives the money on time.
They manage the settlement risk?
Exactly. They manage the entire clearing and settlement process, matching trades, handling funds, and securities transfer. They're crucial for market stability. And they're constantly working to make settlement faster, like the move to T+1 cycle we mentioned earlier.
Makes the whole system trustworthy. Okay, now for some really specialized mechanisms and concepts. Let's start with the book building method for IPOs.
Right. This is a common way companies price their IPOs.
You said it's a sophisticated way for a company going public to figure out the right price for its shares and gauge demand, instead of just setting a fixed price up front.
Like saying, our shares are $10 each, take it or leave it.
Right. Instead, they offer a price range or a price band, and investors submit bids saying how many shares they want at different prices within or sometimes above that band.
Exactly. It's a price discovery process.
May.
The company, working with its investment bankers or lead merchant bankers, prepares a preliminary prospectus called a draft red herring prospectus, which has details about the company and the issue, but no final price, just the band. They then market the issue and collect bids from interested investors, especially large institutions, over a defined bid period, typically a few days.
And investors can change their bids.
Yes, during the bidding period, investors can revise their bids, both price and quantity. The bankers build an order book, which gives them a real-time view of demand at different price levels.
So they see where the interest lies.
Precisely. Based on this demand shown in the order book, the company and its bankers jointly decide the final issue price, often called the cutoff price. Usually they pick the highest price at which they can sell all the shares they intend to offer.
Maximizes their proceeds while ensuring it sells out.
That's the goal. This method is often preferred over a fixed price method because it helps ensure the company prices its shares appropriately based on actual market appetite before finalizing the deal. You get real-time feedback.
Makes sense. Are there other key players involved in these public issues?
Oh, yes. Besides the lead managers or merchant bankers who manage the whole process, you have underwriters. They often guarantee to buy any unsold shares, ensuring the company raises the minimum amount it needs. They also help market the issue to big investors.
They take on some risk.
They do. You also have bankers to the issue who handle the application money, refunds, etc. Brokers to an issue help drum up retail interest. If it's a debt issue like debentures, you'll have debenture trustees who protect the interests of the debenture holders. And registrars to the issue handle the application processing, allotment, and record keeping. It's a whole team effort.
Right. Now let's look at the backbone. Market infrastructure institutions, or MIIs.
MIIs are simply the stock exchanges, depositories, and clearinghouses we've been discussing. They are absolutely critical economic infrastructure.
Why so critical?
Think about it. If these systems fail, if trading halts or settlement breaks down, or people can't access their holdings, the entire financial market could seize up. It could trigger wider economic instability.
Systemic risk.
Exactly. That's why regulators impose extremely stringent guidelines on them for things like business continuity plans, BCP, and disaster recovery, DR. They need to be able to restore operations very, very quickly if something goes wrong, like within minutes, and ensure minimal data loss. Their resilience is paramount for financial stability.
Makes sense. Now, talking about exchanges, you mentioned their evolution. Demutualization and corporatization. What's that about?
Historically, many stock exchanges were owned and controlled by their members, primarily the brokers who traded on them, like a private club.
Okay.
This often led to conflicts of interest. Were they running the exchange for the benefit of all users, or just the brokers? Demutualization is the process of transforming such a member-owned mutual organization into a standard shareholder-owned company.
Like any other corporation.
Essentially, yes. It separates ownership and control from the right to trade on the exchange. This change, which many exchanges globally, including in India, have undergone, significantly enhances transparency, governance, and helps protect investor interests by reducing those potential conflicts. Often, regulations limit how much brokers can own or control on the board post-demutualization.
Interesting. Another development, interoperability in the stock market.
Right. Before this came in, around 2019 in India, for instance, if you traded on Exchange A, your trade had to be cleared and settled by Exchange A's own dedicated clearing corporation. Same for Exchange B. They were siloed.
Stuck in one system.
Exactly. Interoperability changes that. It means a trade executed on any recognized exchange can be settled through any approved clearing corporation chosen by the broker.
Yeah, so brokers get a choice.
Yes. This creates competition among clearing corporations, which can lead to lower costs for brokers and investors. It improves operational efficiency, allows brokers to manage their collateral more effectively across exchanges, and crucially, enhances the overall stability and continuity of the settlement process. If one clearinghouse has an issue, trades can potentially be routed through another.
More resilience again. Good. Now, of course, not all market activities are legitimate. Let's touch upon a couple of illegal or unofficial practices. First, front-running.
Right, front-running is an illegal trading practice. It happens when a broker or an intermediary uses non-public knowledge of a large impending client order to make a personal trade before that client's order is executed.
So they know a big buy order is coming, which will likely push the price up.
Exactly. So they quickly buy some for themselves just before executing the client's large order, hoping to profit from the price move their client's own order will cause. It's a breach of their duty to the client.
How does that differ from insider trading? People often confuse them.
Good question. They're both illegal, but the information is different. Insider trading involves trading based on material, non-public information about a company's fundamentals, like knowing about a merger, a bad earnings report, or a new product failure before it's announced publicly.
Information about the company itself.
Yes. Front-running, however, is specifically about misusing knowledge of an impending large trade or transaction that is likely to move the market. It's abusing knowledge about market flow, a breach of fiduciary duty concerning client orders, rather than inside knowledge about the company's secrets.
Subtle but important distinction in what's being misused.
Okay.
And then there's the gray market. Unofficial, you said.
Completely unofficial. The gray market is an informal platform where trading of unlisted shares, or more commonly applications for upcoming IPOs, happens before those shares officially list on an exchange.
Trading before it's even legal to trade.
Well, trading the expectation or the application itself, it's entirely unregulated, operates outside the official system. But it serves as a kind of informal barometer, giving some indication of investor sentiment and the potential listing price for an IPO.
So people watch it for clues.
Yes. Market participants often look at the gray market premium, GMP. That's the extra amount buyers are willing to pay for shares in the gray market above the official IPO offer price. If the IPO price is 500 and the GMP is 35, it suggests strong initial demand, with people willing to effectively pay 535 in the gray market. But it's risky and unregulated.
Understood. Okay, let's quickly define some other important market mechanisms and terms. The green shoe option sounds botanical.
Yes, but it's a price stabilization mechanism used in IPOs. Named after the green shoe company that first used it. It essentially allows the underwriters of an IPO to sell more shares than originally planned, usually up to 15% more if demand is very high.
Overallotment.
Yes. And critically, it also gives them a mechanism to support the price after listing. If the price starts to fall below the IPO price shortly after trading begins, the underwriters can use the proceeds from selling those extra shares to buy shares back from the open market, creating demand and supporting the price.
So it helps smooth out initial volatility.
That's the main purpose. Helps stabilize the share price immediately following the IPO.
Okay. Then we have circuit breakers. What do they break?
They break trading. These are predefined percentage limits on how much a major market index, like the Sensex or Nifty, can move up or down in a single day compared to the previous day's close.
Like 10%, 15%, 20%?
Exactly. Those are common thresholds. If the index hits one of these limits, trading is automatically halted across the entire market for a predetermined period.
A timeout for everyone.
Precisely. They're designed to curb panic selling or excessive speculation during periods of extreme market volatility, giving investors a chance to pause, reassess, and absorb information before resuming trading.
Prevents crashes from spiraling too fast. Got it. Algorithmic trading or algo trading.
This is the use of computer programs and complex mathematical models to make trading decisions and execute orders automatically at incredibly high speeds.
Robots trading.
Essentially, yes. It's widely used by institutional investors, hedge funds, and proprietary trading firms for strategies that require speed and precision impossible for humans. High-frequency trading, HFT, is a subset of this.
Okay. Arbitrage.
Arbitrage is exploiting tiny price differences for the same asset in different markets or in different forms. For example, if a stock is trading at $10 on the NYSE and simultaneously at $10 on another exchange, an arbitrager would try to instantly buy on the NYSE and sell on the other exchange to capture that 1 cent difference, theoretically risk-free.
Sounds easy, but probably hard in practice.
Very hard. Those opportunities are tiny and vanish in milliseconds because of, well, algorithmic trading. But the quest for arbitrage helps keep prices consistent across different markets.
It enforces efficiency. Okay. And when you look at stock quotes, you see a bid price and an ask price.
Yes, the bid price is the highest price a buyer in the market is currently willing to pay for security.
What someone will give you for it right now.
Exactly. The ask price, sometimes called the offer price, is the lowest price a seller in the market is currently willing to accept for that security.
What you have to pay to get it right now.
Right. The difference between the highest bid and the lowest ask is called the bid-ask spread.
And why does that spread matter?
It's a key indicator of liquidity. Liquidity is how easily an asset can be bought or sold quickly without significantly affecting its price. A narrow or tight bid-ask spread, meaning little difference between the best buying and selling prices, indicates high liquidity. Lots of buyers and sellers, easy to trade. A wide spread suggests lower liquidity, meaning it might be harder or more costly to trade quickly.
Got it. Spread equals cost of immediacy. Now, common terms people throw around: bull market and bear market.
Simple definitions, really. A bull market is a period characterized by generally rising prices and positive investor sentiment. People are optimistic, they expect prices to go up. Think of a bull thrusting his horns upwards.
Optimism.
Yes, a bear market is the opposite. A period of sustained decline in prices, usually defined as a drop of 20% or more from recent highs, accompanied by widespread pessimism. Investors expect prices to fall further. Think of bears swiping downwards.
Pessimism and decline. Okay. And blue chip stocks.
These are stocks of large, well-established, financially sound companies with a long history of reliable earnings, solid management, and often dominant positions in their industries.
Like household names.
Often, yes. Think major banks, established tech giants, large consumer goods companies. They're considered relatively safe, stable investments. Hence the name blue chips were traditionally the highest value chips in poker.
Ah, okay. Finally, short selling. Sounds counterintuitive. Selling something you don't own.
It does. But it's a valid strategy, though risky. Short selling is basically betting that a security's price will go down. Here's how it works. You borrow shares of a stock that you believe is overvalued or likely to fall. You immediately sell these borrowed shares in the open market at the current high price.
Okay.
Then you wait. If you're right and the price falls, you buy the same number of shares back at the new lower price. You then return these shares to the lender you borrowed them from. Your profit is the difference between the price you sold them at initially and the lower price you bought them back at, minus any borrowing costs or dividends paid where you held the short position.
So you profit from the price drop. What if the price goes up?
Then you're in trouble. You still have to buy the shares back to return them, but now you're buying them at a higher price than you sold them for. Your potential losses on a short sale are theoretically unlimited because there's no ceiling on how high a stock price can go. It's a high-risk strategy.
Definitely sounds risky. Okay, let's shift gears. Companies seeking to expand need financing. They generally have two primary methods: issuing equity, which we've discussed, or taking on debt. Let's do a deeper dive into the debt market specifically.
Right. Besides borrowing from banks or other lenders, companies and governments can issue debt instruments directly into the market. The debt market, broadly, is where these fixed income securities instruments that promise fixed interest payments and repayment of principal are bought and sold.
Fixed income because the payments are usually predictable.
Generally, yes, though floating rate bonds exist too. A key benefit for investors is that this market provides an exit option. If you hold a bond, you don't necessarily have to wait until maturity. You can often sell it to another investor in the secondary debt market if you need the cash or want to change your investment.
Provides liquidity for debt too.
Exactly. And this market typically has two main segments. The government securities market, or GSEC market, deals with bonds issued by central and state governments to raise funds. These are often considered among the safest investments because governments can, well, tax or print money to repay.
Lowest default risk, usually.
Typically. Then there's the corporate debt market, which involves fixed income securities issued by non-government entities, basically, companies raising debt capital. This segment is crucial for channeling funds to the private sector, offering an alternative or supplement to bank loans.
This raises an important question for many individual listeners. How can I, as a retail investor, participate in buying, say, government securities directly? It often seems like a market for big institutions.
That used to be largely true, but things are changing. In some markets, like India, the central bank has made a concerted effort to open this up. For example, the RBI launched the Retail Direct Scheme in late 2021. This allows individual investors like you to open a special online account called a Retail Direct Gilt (RDG) account directly with the Reserve Bank of India.
Directly with the central bank. Wow.
Yes. And through this account, you can invest directly in government securities, both central government bonds, treasury bills, and even state development loans right when they are first issued in the primary market auctions.
Using non-competitive bidding, perhaps?
Exactly. Using the non-competitive bidding facility we talked about earlier, which makes it easy. And you can also buy and sell existing GSECs in the secondary market through the RBI's platform. Payments can often be made easily via internet banking or UPI. And currently, there are no fees charged by RBI for this facility.
That's a significant development for democratizing access to safe investments.
It really is. It breaks down barriers for retail participation in the GSEC market.
Okay, what kinds of instruments are typically traded in the broader debt market, both short-term and long-term?
Right, we can broadly categorize them by duration. For short-term financing, typically up to 1 year, used for working capital needs. Commercial paper, CP. These are unsecured short-term promissory notes issued by highly rated corporations, primary dealers, and financial institutions. Think of it as a corporate IOU. They're issued at a discount to face value, mature within a year, minimum 7 days.
Unsecured, so rating matters a lot.
Absolutely. Certificate of deposit, CD. These are negotiable money market instruments issued by banks and select financial institutions against funds deposited for a specified period, again, up to 1 year. Minimum amounts are usually high, like 5 lakh in India. They offer a fixed interest rate.
So like a fixed deposit you can sell.
In essence, yes. Negotiable means it can be sold in the secondary market before maturity. Now, for long-term financing, instruments with maturity of more than 1 year, used for capital expenditure, expansion. Fixed-rate bonds, the most common type we discussed, pay a fixed interest coupon, usually semi-annually, with the principal repaid at maturity.
The standard bond.
Pretty much. Floating-rate bonds. Again, as mentioned, the interest rate isn't fixed, but resets periodically based on a benchmark rate. Attractive in a rising rate environment for investors, potentially cheaper for issuers if rates fall. Debentures. These are typically long-term debt instruments issued by companies. They can be secured, backed by specific company assets, offering more safety, or unsecured. Interest rates are usually fixed.
And can debentures be converted to equity?
Sometimes. That's a key distinction. You have non-convertible debentures, NCDs, which are purely debt. But companies can also issue partially convertible debentures, PCDs, or fully convertible debentures, FCDs, which allow the holder to convert them into equity shares under specific terms. Gives the investor potential upside.
So debt with an equity kicker.
Exactly. Zero coupon bonds, ZCBs. As we covered, issued at a discount, redeemed at face value at maturity, no periodic interest. Often used for longer maturities, too, sometimes called deep discount bonds. Cash management bills, CMBs. We mentioned these with GSECs. Short-term, zero coupon, like T-bills but for maturities less than 91 days. Used by the government for temporary cash flow mismatches.
Okay.
Market-linked debentures, MLDs. These are more complex. They are debt instruments, but their return is not fixed. It's linked to the performance of an underlying market index or security, like the Nifty index. They might offer principal protection, or they might not. Higher potential returns, but also different risks.
So a hybrid debt market linked instrument.
You can say that. And the regulatory framework for the debt market often involves different authorities. For instance, in India, the RBI primarily regulates government bonds, T-bills, CMBs, and debt issued by banks and NBFCs. SEBI, the securities market regulator, oversees all corporate bonds, both public sector and private, and critically, any debt security that is listed on a stock exchange.
So listing brings it under SEBI's watch.
Yes. And the Ministry of Corporate Affairs, MCA, has a role in regulating unlisted debt securities under the Companies Act. It's a layered approach to ensure oversight. Regulators are also actively trying to deepen the corporate bond market, encouraging larger companies to raise more funds via bonds rather than just relying on bank loans.
Makes sense for diversification of funding. Okay, let's pivot now to the money market, the other side of the maturity coin, focusing solely on the short-term aspect of the financial system.
Right. The money market is where funds are borrowed and lent for very short periods, typically ranging from overnight up to 1 year. It's absolutely crucial for managing short-term liquidity for banks, governments, and corporations. Think managing daily cash flows, meeting temporary funding gaps.
The system's plumbing for short-term cash.
Excellent analogy. Central banks, like the RBI, are major players here. They use the money market extensively to implement their monetary policy managing interest rates and overall liquidity in the banking system through various tools. Structure-wise, it typically has an organized sector, which is regulated and includes the central bank, commercial banks, cooperative banks, NBFCs, large corporations, mutual funds, especially money market mutual funds, and specialized institutions like the Discount and Finance House of India, DFHI. And in some economies, there's also an unorganized sector, largely outside formal regulation, which might include indigenous bankers, moneylenders, chit funds, etc., though the focus for stability is on the organized sector.
So who are the key participants in this organized money market?
The big players are the RBI, or the relevant central bank, scheduled commercial banks, cooperative banks, large corporates managing their working capital, mutual funds offering liquid funds, and primary dealers who help make the market for government securities.
And what specific instruments are traded here in the short-term arena?
A key part is the interbank money market. This is where banks lend and borrow funds among themselves, mostly unsecured, to manage their reserve requirements and short-term liquidity needs. Call money is for overnight borrowing lending. Very short-term, notice money, is for periods from 2 days up to 14 days. Term money is for periods exceeding 14 days up to 1 year. The interest rate in this market, often reflected in a weighted average call rate, WACR, is a key indicator of liquidity conditions in the banking system.
What banks charge each other for short loans? Okay.
Then you have Treasury bills, T-bills. As we've said, short-term debt issued by the government via the central bank, typically 91, 182, 364-day tenors. Zero coupon, issued at discount, redeemed at face value. Considered risk-free, and banks can use them for their statutory liquidity ratio, SLR, requirements.
Very liquid and safe.
Yes. Cash management bills, CMBs. Introduced in 2010 in India. Similar to T-bills, zero coupon, SLR eligible, but specifically for maturities less than 91 days. Used for the government's temporary cash flow mismatches. Certificate of deposit, CD, we mentioned these earlier. A negotiable unsecured money market instrument issued by banks and FIs up to 1 year maturity, minimum 5 lakh. Issued in DMAT form now. Banks can buy them back after 7 days, offering some liquidity. Commercial paper, CP. Also discussed, unsecured promissory note issued by corporates, PDs, FIs, minimum 7 days, max 1 year. Denominations of 5 lakh or multiples. Issued at discount. Needs a decent credit rating, especially for large issues.
These CPs and CDs seem to bridge the corporate and money markets.
They absolutely do. They allow corporations and banks to tap into short-term market funding. Another important mechanism is tri-party repo. Repo stands for repurchase agreement. In a repo, one party borrows funds by selling securities and simultaneously agreeing to repurchase them at a later date at a slightly higher price.
So it's like a collateralized loan.
Exactly. The securities act as collateral. Tri-party repo is a type of repo where a third party, like a clearing corporation, for example, a CCAL in India, acts as an intermediary between the two parties to manage the collateral, holding it, valuing it, ensuring margins are met. This makes the process safer and more efficient than bilateral repos. It largely replaced an older system called CBLO in India.
Adds a layer of safety and management.
Yes. And repo and its opposite, reverse repo, where the central bank borrows from banks absorbing liquidity, are a key tool is used by central banks like the RBI to manage day-to-day liquidity in the banking system and signal interest rate direction. Finally, money market mutual funds, MMFs. These were introduced to allow individuals and small investors to participate indirectly in the money market.
Pooling money to buy these instruments.
Precisely. These funds invest exclusively in short-term, high-quality money market instruments like T-bills, CPs, CDs. They offer high liquidity and relatively low risk compared to other mutual funds. Regulated by SEBI in India, but banks setting them up also need RBI clearance.
So bringing it all together again, what does this detailed look? Tell us about the big picture comparison between capital markets and money market.
Okay, let's crystallize the key differences. Maturity. Money market is strictly short-term, less than 1 year. Capital market is for the long term, more than 1 year. Risk. Money market instruments generally have lower risk, less credit risk due to high-quality issuers, and less interest rate risk due to short duration. Capital market instruments, stocks, long-term bonds, carry higher risk.
Duration is key for risk.
Absolutely. Purpose. Money market caters to short-term operational needs, working capital, managing temporary cash imbalances, providing liquidity. Capital market provides the fixed capital needed for long-term investments, buying land, building factories, funding R&D, infrastructure development. Regulation. While often coordinated, different regulators might take the lead. For example, in many countries, the central bank, like RBI, primarily oversees the money market and banking liquidity. A securities market regulator, like SEBI, focuses more on the capital market, regulating stock exchanges, brokers, mutual funds, and listed securities, both equity and debt.
Clear distinctions in function and focus. Let's do a slightly deeper dive now into government securities, or GSECs. You called them the bedrock.
They really are. A GSEC is a tradable instrument issued by the central or state government acknowledging its debt obligation. They represent government borrowing.
And they come in short-term and long-term forms, as you've mentioned.
Exactly. Let's recap and add detail. Short term. Primarily Treasury bills, T-bills. Maturities of less than 1 year, specifically 91 days, 182 days, and 364 days typically. They are zero coupon securities, no direct interest payments, issued at a discount, redeemed at face value. Considered virtually risk-free. Short term. Also, cash management bills, CMB. Introduced in India in 2010. Similar characteristics to T-bills, zero coupon, issued at discount, but specifically for maturities less than 91 days. Used to meet temporary cash flow mismatches in the government.
Ultra short-term borrowing.
Yes, long-term. These are dated government securities or government bonds. Mature in 1 year or more, often ranging from 5 to 40 years. Unlike T-bills CMBs, they usually carry a fixed or sometimes a floating coupon, interest rate, typically paid half-yearly. The principal is repaid at maturity.
And states issue debt, too.
Yes, state governments in India issue state development loans, SDLs. These are also dated securities, functioning very similarly to central government bonds. Fixed coupon paid half-yearly, principal repaid at maturity. They are eligible for banks' SLR requirements and are actively traded. Beyond these core types, there are other variations you might encounter. Fixed-rate bonds, the most common type of dated GSEC, with the coupon rate fixed for the entire life of the bond. Floating-rate bonds, FRBs, these have a variable coupon rate that is reset at pre-announced intervals, for example, every 6 months, usually linked to a benchmark rate like the T-bill yield plus a fixed spread. First issued in India in 1995.
Protection against interest rate changes.
For the investor, yes,
Yeah.
capital index bonds. Here, the principal amount you get back at maturity is linked to an inflation index, like WPI or CPI. Protects your principal's purchasing power. Issued first in India in 1997, but not very common. Inflation index bonds, IBs. These go a step further and protect both the coupon payments and the principal against inflation. The coupon rate is applied to the inflation-adjusted principal, reintroduced in India in 2013.
So real return bonds.
Effectively, yes. Special securities. Sometimes the government issues bonds directly to entities like oil marketing companies, oil bonds, fertilizer companies, fertilizer bonds, or the Food Corporation of India, food bonds, instead of giving them cash subsidies. These are usually long-dated, might have slightly higher coupons, but are not typically XLR eligible, though they can be used as collateral for repo transactions.
A way to manage subsidy payout.
A fiscal management tool. Strips. Separate trading of registered interest and principal of securities. This is interesting. Strips aren't issued directly by the government. They're created by investment banks or dealers by taking a regular coupon-bearing government bond and stripping each individual coupon payment and the final principal payment into separate securities.
So breaking a bond into many mini bonds.
Exactly. Each separated cash flow, each coupon payment, and the principal payment becomes a distinct zero-coupon bond that can be traded individually. They are popular because they have zero reinvestment risk, as they are ZCBs, and offer predictable cash flows at specific future dates, great for matching future liabilities.
Clever financial engineering.
It is. Sovereign Gold Bond, SGBs, issued by the government of India via RBI. These are denominated in grams of gold. The price is linked to the prevailing gold price. Investors get a fixed interest rate, currently 2.5% PA on the initial investment amount, paid semi-annually, plus the capital gains if gold prices rise when they redeem. Minimum investment 1 gram, maximum 4 kilograms for individuals per year, 8-year tenor, but exit option after 5 years. They offer a way to invest in gold without physically holding it, plus earn interest.
Interesting alternative to physical gold. How are regular GSECs actually issued? You mentioned auctions.
Yes, primarily through auctions conducted by the central bank, RBI in India, on its electronic platform, often called eCouper. Large participants like banks, primary dealers, insurance companies, provident funds bid directly in these auctions.
Big players.
Right. Smaller players, or those not on the eCouper platform, including retail investors outside the retail direct scheme, cooperative banks, etc., typically participate indirectly through banks or primary dealers. Holding GSECs is now mostly mandatory in dematerialized electronic form, especially for RBI-regulated entities. The RBI's Public Debt Office, PDO, acts as the registry and central depository for GSECs, held directly with them in subsidiary general ledger, SGL accounts.
And retail investors.
Retail investors can hold GSECs in their RBI Retail Direct Gilt account, or indirectly through a gilt account maintained with a bank PD, or even in their regular DEMAT account held with depositories like NSDL, CDSL, just like shares.
So multiple ways to hold them electronically. What kinds of auctions are used?
Mainly 2 types for dated securities. Yield-based auctions. This is common for issuing new GSECs. Investors bid the yield, interest rate, they expect. Bids are accepted starting from the lowest yield upwards until the total amount to be issued is reached. The highest accepted yield becomes the cutoff yield. Usually it's a uniform price auction, meaning all successful bidders get the security at the same cutoff yield regardless of what they bid.
Everyone gets the same rate.
In a uniform price auction, yes. price-based auctions. This is used when the government reissues an existing security. Since the coupon rate is already fixed, bidders quote the price they are willing to pay per euro of face value. Bids are accepted starting from the highest price downwards. This is often a multiple price auction, meaning successful bidders pay the actual price they bid. So different investors might pay slightly different prices for the same bond in the same auction.
Pays what you bid. Okay. And you mentioned bidding categories.
Yes, two main types. Competitive bidding. This is where bidders quote a specific price or yield. It's generally for well-informed institutional investors who understand market conditions. They compete on price yield. Non-competitive bidding. This facility is designed specifically to encourage wider participation from retail investors, small cooperative banks, etc., who may not have the expertise or infrastructure for competitive bidding. They agree to accept the allotment at the weighted average price or yield that emerges from the competitive bids in the auction. A certain portion of the total issue size is often reserved for non-competitive bidders.
Makes it accessible for smaller players.
Good. So the major players are banks, primary dealers, institutional investors like insurance and mutual funds, foreign portfolio investors, FPIs within limits, corporates, and now increasingly retail investors.
It covers the main landscape, yes.
We've mentioned zero-coupon bonds, ZCBs, several times, especially T-bills and strips. Let's just do a final deep dive to make sure we fully grasped them. A debt instrument that doesn't pay periodic interest. That's the defining feature. Instead of getting regular coupon payments, it's sold at a price below its face, or par, value, and then redeemed at its full face value when it matures. The implicit interest earned by the investor is simply the difference between the redemption price, face value, and the discounted issue price, also sometimes called deep discount bonds, especially for longer maturities.
Let's use your example. Face value 1,000, maturity 4 years, issue price 950.
Right. No explicit coupons are paid over the 4 years. It's issued below face value at 950. It's redeemed at face value, 1,000. The implicit interest is 54 years earned over the 4-year period.
Simple in concept. Any special features?
Two key ones related to risk and cash flow. Duration, maturity. Because there are no intermediate cash inflows, coupons before maturity, a ZCB's duration, its price sensitivity to interest rate changes, is exactly equal to its time to maturity. This makes their price very sensitive to rate changes, especially for long maturities. Single cash inflow and no reinvestment risk. The investor receives money only once at maturity. Since there are no intermediate coupon payments to reinvest, ZCBs have no reinvestment risk. This is a significant difference from coupon bonds, where you have to worry about reinvesting the coupon payments at potentially lower rates.
That lack of reinvestment risk is a big plus for predictability. What are the main types of ZCBs in India?
As we've covered, Treasury bills, T-bills, cash management bills, CMBs, both issued by the government, and strips, which are created by separating the cash flows of regular government bonds. Each stripped coupon or principal payment effectively becomes a ZCB.
Okay, so final check. What's the fundamental difference between ZCBs and traditional coupon bonds summarized?
Let's break it down. Cash inflows. ZCBs have only one cash inflow for the investor at maturity. Coupon bonds have multiple cash inflows. Periodic coupons plus the final principal. Reinvestment risk. VCBs have zero reinvestment risk. Coupon bonds do have reinvestment risk associated with the periodic coupon payments. Duration. A ZCB's duration is equal to its maturity. A coupon bond's duration is always less than its maturity because you get some cash back sooner via coupons.
Crystal clear.
Okay.
Let's broaden out again. Bonds are debt instruments where you loan money to an entity, government, municipality, company. They're considered fixed income securities. Let's talk about their key features.
Right. Every bond, regardless of type, has some core characteristics defined in its bond indenture, the legal contract. Issue price. The price at which the bond is initially sold, often face value for standard coupon bonds, but at a discount for ZCBs. Face value, principal par value. The nominal value of the bond, stated on the bond certificate. It's the amount on which interest, coupon, is typically calculated, and it's the amount usually repaid to the bondholder at maturity, though sometimes bonds are redeemed at a premium.
The amount borrowed, essentially.
Usually, yes.
Yeah.
Coupon interest rate, the stated interest rate the issuer agrees to pay the bondholder. This rate, multiplied by the face value, determines the periodic cash payment. Coupon frequency. How often the coupon payments are made commonly semi-annually, but can be annual, quarterly, or even monthly. Maturity date. The specific date in the future when the issuer repays the principal, face value, to the bondholder, and bond ceases to exist. Redemption value. The value paid to the bondholder at maturity. Usually face value, but sometimes can be different based on the bond's terms. Duration of bond. We've touched on this. It's a crucial measure of a bond's price sensitivity to changes in interest rates. It's not the same as time to maturity, but is a weighted average of the present values of all the bond's cash flows. Coupons and principal. Longer duration means higher sensitivity.
More volatile price swings with rate changes.
Exactly. Sinking fund provision. Some bonds require the issuer to periodically set aside money into a separate sinking fund, specifically to repay the bondholders at maturity. This reduces default risk for investors as the funds are gradually accumulated. Credit quality. A major factor determining the coupon rate. Bonds are rated by credit rating agencies based on the issuer's perceived ability to repay. Lower rating, higher perceived default risk, means the issuer has to offer a higher coupon rate to attract investors. Government bonds are often the highest quality investment grade. Bonds below investment grade are called high yield, or junk bonds, higher risk, higher potential return.
Risk-return trade-off again.
Always. Call option. Callable bonds. As we mentioned, this gives the issuer the right, but not obligation, to redeem the bond before its scheduled maturity date, usually at a pre-specified price. Issuers might do this if interest rates fall significantly, allowing them to refinance their debt at a lower cost.
Bad for the investor who gets repaid early and has to reinvest at lower rates.
Right. That's called reinvestment risk. Because of this disadvantage to the investor, callable bonds typically offer a slightly higher coupon rate than comparable non-callable bonds. Option. Puttable bonds. This gives the lender investor the right, but not obligation, to demand early repayment from the issuer before maturity, usually on specific dates and at a set price. Investors might exercise this if interest rates rise significantly, allowing them to get their principal back and reinvest at the new higher rates.
Good for the investor in a rising rate scenario.
Yes. Because this benefits the investor, puttable bonds usually offer a somewhat lower coupon rate than comparable non-puttable bonds.
Fascinating how these options affect the pricing. Okay, now for the multitude of bond types. It seems like there's a bond for every occasion.
They feel that way.
Okay.
They're designed to meet different financial needs or risk profiles. Let's try to categorize them. On the basis of coupon payments, plain vanilla straight bullet bonds, the simplest type. Fixed coupon rate, defined maturity date, principal repaid in a lump sum bullet at maturity. Issued and usually redeemed at face value.
The standard model.
Yes, zero coupon bonds. We know these well now. No periodic coupon, issued at discount, pay full face value at maturity. Deferred coupon bonds. These pay no coupon for an initial period, but then start paying a usually higher coupon later on. Might be used by companies starting a long project with no immediate cash flow. Step-up bonds. The coupon rate isn't fixed for life, but increases, steps up, after predetermined periods, for example, 5% for first 3 years, then 6% for next 3, etc. Also called dual or multiple coupon bonds. Floating rate bonds, FRBs. Coupon rate is linked to a benchmark interest rate like LIBOR, MIBOR, T-bill rate, plus a fixed spread, and it adjusts periodically around every 3 or 6 months.
Protects against rising rates.
Correct. Inverse floaters, these are more exotic. The coupon rate moves in the opposite direction to the benchmark rate. High risk for sophisticated investors betting on rates falling. Participatory bonds, income bonds. These offer a fixed base interest rate, but the coupon may increase if the issuing company's profits or income exceed certain levels. Returns might be capped or might not decrease if income falls. Income bonds. Links returns to company performance somewhat. Payment in kind, PIK. Bonds. These allow the issuer under certain conditions, often financial stress, to pay interest in the form of additional bonds rather than cash, at least initially. Carry higher rates due to higher risk and deferred cash flow. Inflation index bonds. As discussed, coupon flows and penny or principal are linked to an inflation index to protect purchasing power.
Quite a variety just based on coupons. What about redemption features?
On the basis of redemption. Perpetual bonds. Colonsals. These bonds theoretically have no maturity date and pay coupons forever, or for the entire life of the issuing company. Very rare, though some bonds with extremely long maturities, for example 100 years, approximate this. Callable bonds. As defined, the issuer has the option to redeem early. Puttable bonds. The bondholder has the option to demand early repayment. Serial bonds. Instead of repaying the entire principal at maturity, a portion of the total bond issue matures and is paid off each year over a series of years. Allows the issuer to gradually reduce its debt burden.
Spreads out the repayment.
Okay.
And convertibility.
On the basis of convertibility. Convertible bonds. These give the bondholder the option to convert the bond into a predetermined number of equity shares of the issuing company at specified times and prices. Offers the safety of a bond, fixed income, with the potential upside of equity appreciation.
Best of both worlds, potentially.
If things go well, yes. Lower coupon than straight debt, but potential for capital gains via conversion. Foreign currency convertible bonds, FCCBs. An equity-linked debt instrument issued in a foreign currency, for example US dollars, by an Indian company, subscribed by non-residents. Pays fixed interest, but gives the holder the option to convert into equity shares or global depository receipts, GDRs, of the company later. Foreign currency exchangeable bonds, FCCBs. Similar to FCCBs, issued in foreign currency by an Indian company, but these are exchangeable into the equity shares of another company, usually one belonging to the same promoter group, not the issuing company itself. Requires RBI approval.
Interesting twist. Exchanging for shares of a related company.
Yes, non-convertible debentures, NCDs. As mentioned, these are pure debt instruments issued by companies to raise long-term capital, often via public issues. Fixed tenure, regular interest payments, coupon, principal repaid at maturity, no option to convert into equity. They can be secured, backed by company assets, or unsecured, rated by agencies like CRISIL, ICHE, etc.
The standard corporate debt raising tool, besides loans.
Very much so.
Okay, any other major types we should know?
Other types of bonds, often named based on issuer location currency or purpose. Yankee bonds. A U.S. dollar-denominated bond issued in the U.S. market by a non-U.S. entity, frequently a European company issuing dollar bonds in New York. Samurai bonds. A Japanese yen-denominated bond issued in the Japanese market by a non-Japanese entity. Shogun bonds. A non-yen-denominated bond for example U.S. dollar, issued in the Japanese market by a non-Japanese entity. Euro bonds. These are international bonds issued in a currency other than the currency of the country where the bond is issued. E.g., a U.S. company issuing dollar bonds in London, they are typically less regulated than domestic bond.
Names for the market, not the currency sometimes. Confusing.
It can be. Masala bonds. These are rupee-denominated bonds issued outside India by Indian entities, introduced by the IFC in 2014. Allows Indian companies to raise funds internationally in rupees, so the currency risk stays with the international investor, not the Indian issuer.
Ah, shifts the currency risk offshore. Clever.
Yes. Green bonds. Debt securities where the proceeds are specifically earmarked for financing projects that have positive environmental or climate benefits, like renewable energy projects, energy efficiency improvements, clean transportation, etc. Also called climate bonds, growing rapidly.
Funding sustainability. Excellent. So, after all that, let's revisit the common interchangeable terms. Bond versus debenture. What's the final verdict on the distinction, if any?
Okay, while often used interchangeably in casual conversation, especially in the U.S., there are technical distinctions, particularly emphasized in markets like India or the U.K. Security. This is often the main point. Bonds are almost always considered to be secured by specific collateral or assets of the issuer. Debentures can be secured, but they can also be unsecured, relying only on the general creditworthiness and reputation of the issuer. Unsecured debentures are riskier.
Security is the key differentiator.
Often, yes, issuers. Consequently, bonds, being highly secured, are typically associated with governments, municipalities, and large, stable financial institutions. Debentures are more commonly issued by private sector companies. Returns risk. Because bonds are generally more secured, they usually offer slightly lower interest rates, coupons. Debentures, especially unsecured ones, carry higher risk and thus typically need to offer higher rates to attract investors. Payment on liquidation. In case of bankruptcy, bondholders, especially secured bondholders, usually have a higher priority claim on the issuer's assets than debenture holders. Debenture holders, in turn, generally have priority over preference shareholders and common equity shareholders.
So hierarchy matters in distress.
Absolutely. So, while the terms overlap, thinking bond usually secured, often government FI, and debenture, often corporate, can be secured or unsecured, is a helpful, if slightly simplified distinction in many contexts.
That helps clarify it. Wow, we've truly taken a comprehensive deep dive into the intricate world of financial markets today. From the foundational definitions, what they even are, to the nuances of specific instruments like zero coupon bonds and that whole fascinating array of bond types, we've covered a vast landscape.
Indeed. We've explored how these markets, with their diverse classifications, debt versus equity, exchange versus OTC, money versus capital, spot versus derivatives, and all the crucial intermediaries like brokers, depositories, clearinghouses, how they all work together. They really serve as the lifeblood of economies, don't they?
Yeah.
Facilitating both wealth creation for investors and providing vital capital for businesses and governments to grow and function.
Yeah, understanding those distinctions between, say, primary and secondary markets or the different goals of money in capital markets, it really helps you connect the dots in the global financial system, how money actually flows.
That's it.
It's a complex ecosystem, no doubt about it, but hopefully after this discussion, you feel much more equipped to navigate its terminology and understand its core mechanics. The next time you hear about an IPO or a government bond auction, or maybe even just the bid-ask spread on a stock quote, you'll have, I hope, a new level of insight into how the financial world truly functions.
Hopefully less intimidating now.
Exactly. So here's a thought for you to mull over as we wrapped up. With the rapid pace of technological advancements, we touched on algorithmic trading and the increasing global interconnectedness of these markets. How do you think the very definition of risk and opportunity for the everyday investor will continue to transform in the coming years? Something to think about.